Hey guys, welcome back to the Capital Mindset Show. Today I'm actually going to be going over some things with you regarding some updates, right? So I want to update you guys on some of these stocks that we have talked about in the past. And basically, I'm going to keep it brief with you, just, blunt and upfront with you. So these aren't going to be going into as in-depth as the videos that we've covered in the past regarding these companies, but just to let you know, has anything really changed? So the first one we're going to be talking about is actually Corsair Gaming. So Corsair Gaming, we talked about in the past. It's a YouTube, or used to be a YouTube favorite for obvious reasons, because larger creators were covering it. And yes, some things that have changed is the company does appear to have gotten cheaper. Has my hesitancy in terms of making it a position change? No, that hasn't really. Some of the deteriorations I want to kind of highlight with the company are very real. However, if I were to actually use the actual valuation model, like for example, let's actually, what kind of company was I even typing there? So let's actually plug it in. We'll see what analysts are kind of estimating here, and I'll kind of show you what it is we have to do. So analysts have a buy rating here, $19.16, implying a 47.84% upside. Something I actually would have to do here is actually tell it to do the anomalies here, or sorry, normalization, just simply because we have to kind of account for the fact that the company is, going through something right here, and we actually see, okay, well, what's going on? This supply or cash glut there, and actually we want to probably annihilate this as well. Or sorry, no, we actually don't want to annihilate that. That actually stays. And if we actually go back to here, we can kind of see, okay, well, what happens if, we don't need that much of a margin of safety? Well, it's actually looking quite interesting at the present moment in time. Remember that the peripheral gaming business isn't really growing that much as the actual gaming side. So what I mean by gaming peripherals is, your keyboard, mice, and all that stuff. They have a bunch of competitors. Well, it's a very competitive landscape in general, but their main competitor, I would say, is Lazer. And now the business doesn't have the margins that you might think. Something that I want to highlight, if you go to the 10Q, again, you can see how quick we're going through this. The revenue is actually declining on a 3-month basis from 2021 to 2022. So go figure. A lot of things we talked about in the past regarding the pull forward revenue, yeah, that happened. And by the way, if you guys are curious where you can find all the older videos, you can check it out. Content Library made it super easy for anyone to find old videos, and there you go. Boom, done. Now going over some other companies, the next one I actually want to go over with you is actually Crocs. So Crocs is another company that is kind of interesting because of how cheap it is, and undoubtedly it is cheap. Look at a P of about 4.90. The company has actually gone through kind of a cyclical trend over the past. You can see kind of there up and down, up and down. Sven Carlin kind of pointed to that, but looking a little bit deeper, the business had to do kind of a revival of sorts, and it's actually in again. And that's the thing about retail. A lot of these consumer trends with fashion, one day you're in, one day you're out, another day you're back in, then another day you're back out. They've been actually making some acquisitions, all in the foot apparel category, so good that they're kind of sticking to what they know. It's a company that is kind of able to manage its inventory. It's able to manage its supply chains really well. So I got to commend management for doing that. They've actually also been buying up shares in the past, and we talked about that as well. Back when we did talk about this stock, it was about $80-ish. Now it is undoubtedly cheaper. And I got to say, let's actually plug it in through the model, and we'll come back to this once it's done. So we got to go Crocs. And one thing I will say about this company is it is, I think, perhaps the most interesting of the ones that we're going to be covering today. In terms of whether or not I would add it to the portfolio. So Corsair, no, I wouldn't really add it to the portfolio despite it being cheaper, and I think it's objectively cheaper now. Obviously, the price is lower. But something like Crocs, I think, is the cheapest, and actually, let's plug in some valuation. So if we actually put in 20%, and one thing I want to kind of remove here, or kind of look down here, is we want to make sure that we actually remove this tool. So let me actually do no. All right, so now we actually remove that, and we can actually see more or less, still it's cheap, but not as cheap as it looked before. And this is the company that has actually been buying back shares. I want to show you guys that in the buyback shares right there. You can see it all the way down. Cash flows are expected to rise according to analyst estimates. Revenue is expected to come down a little bit tamed, except there are some growth estimates for some analysts that actually say that's going to continue to grow nicely into the future, and because it's kind of ramping up on its momentum. And so Crocs are pretty comfortable. I actually don't own any Crocs. Maybe I should go out and buy some Crocs for some field research. I'm just kidding, but I'm not kidding at the same time. And interesting company. Honestly, one that is a buyback story. The next one's also kind of a buyback story. So again, just kind of quickly saying, this is the one I'm would be interested in adding. The next one is actually Foot Locker. So Foot Locker is a company that we discussed in this live stream. It's also can be found. I also kind of add this in the Capital Mindset portfolio. There's actually a past trade sheet. I try to link when I remember to actually put it. The actual videos where I discuss the selling part of the stock. So this is the video where I discuss selling the stock, and you can actually watch through it, the whole thing. But yeah, this is the video that you could actually discuss or share my thoughts, or hear my thoughts being shared. Now, something with Foot Locker, it was a stock that we did buy after one of the videos of Foot Locker. And it was after the massive sell-off that we saw. And actually, I know that some of you participated on this with me, but, you know, on like a friendly investment swing trade that, you know, some of you were also participating in, that you just let me know, oh, yeah, I'm also doing this. So I didn't really stay for it very long. And we made a decent profit of about, yeah, it wasn't that much. It was like 15%. But over that time period, if you annualized it, it was a very strong amount. Now, I looked kind of stupid because at one point it actually did even get higher than that. But longer term, it was a company that I didn't really want in the portfolio. It was kind of, I wanted to profit from a massive quick movement, a dead cat bounce of sorts. So here we are today. It's $24.84, well below the original price. Well, not well below, about $4-ish below that buy price. And I'm not really looking to participate in another swing trade of sorts. The setup really isn't the same, if I'm being honest. But another company that does look extremely cheap, sitting at about a P ratio of 3 with a dividend yield of about 6.44%. A lot of people are going to be like, yeah, that's cheap as heck, man. And yeah, the thesis here is that they can, you know, the business doesn't deteriorate as much. Remember that we have Nike coming in and actually saying, I'm going to go direct to consumer. I don't really need you right now. So all this uncertainty, the market's not really into that. The market's kind of going to, of course, punish the stock. And so it's cheap for a reason is what I'm trying to highlight. And oftentimes this is kind of a rolling theme that we always see. Companies like this are cheap for a reason. And something I want to highlight as a little bit of a cautionary tale or a cautionary note that, you know, it's not as, if it's too good to be true, it probably is in some cases. But, you know, if you have some information that I don't have and better information, better research regarding this company, you're going to have an edge in terms of determining what is that fair value. Is it a good time to buy? Is it not a good time to buy? Is there worse things ahead for this company? But all in all, you know, this is not really for me. Now, the next company that I do want to actually go over with you guys is Seritage Growth Property. So Seritage Growth Property is trading down about 4.47% here today, but if you actually take a look at the 1 month, it is up massively. At one point, it was up 110.36% from those lows. And why is that? Well, the company is actually going through a restructuring plan where they're trying to provide value to you, the shareholder, if you own this. This is a company that I actually used as an example of a bad REIT compared to something like Realty Income. So I compared a very bad REIT to a very good equity REIT. And yeah, so here we go, where we did talk about in those videos that a lot of the thesis surrounding SRG was the NAV, so net asset value, that could be realized should the company decide to sell off its assets. Now, here's a big problem. Obviously, if we were talking about this about a year ago, I would be a little bit more optimistic than I am now. Now we have extra uncertainties kind of piled on, and I almost wish the management team would have done this a longer time ago instead of trying to turn things around. Because now with a rising interest rate environment, we do have a less of amount of buyers right out there. It is more uncertain as to whether or not they're going to be able to eke out the best amount. Now, the thing with this company is you might be looking at it at the valuation. You might read somewhere or hear somewhere from another YouTuber that, or maybe the news outlet, that the estimated NAV is about $3 billion. Well, careful with that. Very careful with that, please. Okay. The reason why you got to be careful with that is remember that the company has a lot of liabilities on the end of the balance sheet, right? It's kind of almost like a dirty way of doing it, but look at the enterprise value. And from there, we can kind of say, okay, well, what is the potential sell point of all that property? And then after we pay off all the liabilities and all that jazz, right, afterwards, then that's what can come to us as the shareholder. It's not going to be the full $3 billion, because some people might hear that and they say, oh, market cap of $457 million. We sell all the real estate for $3 billion. I'm going to get $3 billion. No. We have to kind of think about it. It kind of makes sense when you actually break it down. After all those liabilities are paid for and accounted for, then we can see. Unless the terminology, or unless we find out the net amount after accounting for liabilities is about $3 billion. That's a different story. So just find out what the number is, and before you kind of try to engage. Now, the thing is, be very careful. This is not an arbitrage play. You know, use of the word arbitrage is actually butchered in the modern day. Arbitrage implies zero risk. When you find an asset in point A that can sell at point B for a higher amount, for example, and you can pay less for it in point A, sell it in point B, and you can do so over and over and over again with no risk. The word arbitrage has been used in some the stock market, I guess, more recently by, you know, retail as, you know, I buy a stock before it gets acquired, and that's a, you know, merger arbitrage. I know what you mean in the intent of the word, so it's fine. But yeah, with this, it's not an arbitrage play per se. There is a lot of risk, but it could actually pan out to be very fruitful. Now, let's be honest, let's be real. The price has appreciated tremendously, so you have missed out on a massive amount of the gains. If you do get a pullback and then you are interested in kind of making that play, I can see why that can work out. I can see why someone might want to engage in that. So that's the update with this stock as well. So this stock actually has some good news, right? Unlike some of these other stocks that, you know, went down and had some bad news, I think this stock is now at a break-even level relative to when I was discussing it, or maybe slightly higher. So on that, that's the update for Seritage. Of all these companies, the one I'm probably be most interested on kind of putting a speculation into it would probably be Crocs. But yeah, so that covers it. Corsair, Crocs, Foot Locker, Seritage Growth Properties. With that being said, guys, remember, I want you guys to have a great one. And yeah, I'll see you guys in the next one. Bye.